Welcome to The Explainer. Hey, before we jump in, do me a quick favor and hit that like and subscribe button so you never miss another breakdown. All right, so someone out there paid nearly $1,000 for a single trading lesson, and today we're going to unpack exactly what went wrong so you don't have to.
You know, the source material for this kicks off with this quote, and honestly, it just perfectly sets the tone. We are about to walk through a very real, very painful lesson that shows what happens when you overlook a huge risk hiding in plain sight.
And there it is, that's the bill. A real loss of $975 gone from a single trade in less than a day. So, the big question is, how? How did this happen? Let's dig in and find the answer step by step so you can see this trap coming a mile away.
Okay, so to really understand the loss, you've got to understand the setup. This wasn't just some random gamble. Oh no, this was a specific, calculated strategy put on at a moment of, well, total market panic.
So let's paint the picture. The VIX, which you can think of as Wall Street's fear gauge, was absolutely screaming. We're talking a level of 35. That's really, really high. The trader saw all this fear and basically made a bet that the chaos and the high volatility that comes with it was going to stick around for a while.
So here's the actual trade they put on. It's called a double calendar spread. Now don't get hung up on the name. All it really means is that the trader sold some options that were about to expire and then used that cash to help buy other options that expired way farther out in the future. The whole idea is to make money as the short-term options lose value from time decay while volatility stays high. But look at that cost, over $5,000 just to get into the trade. This was not a small bet.
On the surface, the setup makes some sense, right? But the entire trade was built on one single assumption, that all that fear wasn't going anywhere. Well, it was about to vanish. And that brings us to the collapse, what the source calls the Vega Trap.
Just look at how fast this all unraveled. In less than a single day, the VIX didn't just drift lower, it cratered. It absolutely plummeted from a crisis level of 35 all the way down to 22. And just like that, the entire foundation of the trade was gone. Poof!
So why was that VIX collapse so devastating? It all comes down to this term, long Vega. This trade was long Vega, which is just a fancy way of saying it needed high volatility to survive. When the VIX collapsed, it was like someone just pulled the plug and all the value started draining out of the position.
And there's actually a name for exactly how that value got drained. It's called a parallel crush. This means the fear premium wasn't just leaking out of the short-term options, it was being violently sucked out of all the options at the same time, including those expensive long-term ones the trader had bought. That's what completely hollowed out this trade.
All right, now for the painful part. Let's do the autopsy. We're going to look at the hard numbers from when the trade was closed to see exactly how that VIX collapse turned into a nearly $1,000 loss.
So here's the final scorecard. To get out of the trade, you just do the reverse of what you did to get in. And as you can see, the final result was that $975 loss. But the really fascinating part isn't the total, it's seeing where the money was made and where it was lost. First up, the good news. Believe it or not, part of this trade worked perfectly. The short-term option the traders sold lost value just like it was supposed to, and they were able to buy it back for a really nice profit of over $1,900. This part of the plan was working like a charm.
But, and this is the real kicker, here comes the devastating counterpunch. That long-term option they bought, it got absolutely hammered, losing a staggering $2,900. That one single loss completely wiped out the gain from the other side and dragged the whole trade deep into the red.
And this, right here, is the entire lesson of this whole explainer, all in one sentence. The money lost from the volatility crush, that's the Vega risk, was just way, way bigger than the money gained from time decay, the Theta gain. The trader was in a race they were guaranteed to lose.
So, how do we make sure we don't end up paying for the same expensive lesson ourselves? Well, the source material boils this whole painful experience down into a really clear, actionable rule to live by. When you look back, there were 3 fatal flaws here. First, they were buying in at the absolute peak of fear. Second, the math was just impossible. It would have taken 2 straight weeks of the market doing nothing to even break even. And third, as volatility dropped, the trade's potential profit zone literally shrank, leaving no room to escape. And that leads us to the single most important takeaway. When the VIX is sky high, you have to stop thinking of a calendar spread as a simple income trade. It's not. At a VIX of 35, you aren't just collecting a little premium. You are making a direct, high-stakes bet that extreme volatility is here to stay. So this gives us our playbook.
When the VIX is screaming up past 30, the source says to just avoid these kinds of long Vega trades altogether. Instead, you might want to look at trades that are short Vega, things that actually profit when volatility comes crashing back down. The bottom line? Save the calendar spreads for when the market is much calmer and more predictable.
And that really brings us to the final and I think most important question that this whole case study leaves us with. It's something we should all ask ourselves before we click the button. Do you really know what you're betting on? Are you actually trading for income, or have you accidentally just made a huge bet on chaos? And there you have it, a $1,000 seminar all broken down for you. If this real-world lesson was valuable, go ahead and hit that like button, and make sure you're subscribed so you don't miss the next one. Let us know down in the comments what you want to see us explain next time. Thanks for watching.